Will we ever see another financial crisis? It seems that while the stock market took a dip in April, the larger, promised crisis, the ultimate bargain hunting opportunity, may never arrive. The reason? The world has quietly changed the rules of the game? Is this really the case? We've grown accustomed to hearing warnings about impending economic crises and stock market crashes. It felt like a recurring event happening every few years. For instance, the 1997 Asian financial crisis was followed, just a few years later, by the dot-com bubble bursting. Then, a few years after that, the 2008 global financial crisis hit. Our elders taught us that within every crisis lies an opportunity. They believed that if we dared to be greedy when others were fearful, we could seize the moment, buy assets at rock-bottom prices, and potentially change our financial destiny overnight. These devastating crashes were seen as great wealth reshuffles, where the assets of the affluent were sold off to ordinary people at a steep discount. But somewhere along the way, that feeling has vanished. It seems that in the decade plus since the 2008 financial crisis, we haven't witnessed another truly devastating global crash. The opportunity simply hasn't materialized. Consider the US stock market crash during the 2020 pandemic. It plummeted, but within about a month, it had already rebounded and was soon hitting new all-time highs. Similarly, when the US stock market began to fall earlier this year, triggering a global downturn in April, it recovered with remarkable speed. Every time you hear whispers of a crisis and prepare to buy the dip, you find the market has already bounced back. If you feel this way, you're not alone. The legendary investor Warren Buffett built a significant portion of his fortune by buying aggressively during the 2008 financial crisis. Yet during the market dip this past April, he, like many others, found himself unable to act before the market rebounded. As a result, his company's second quarter profits reportedly saw a significant drop. He wasn't the only one on the sidelines. Prominent Wall Street figures like Jim Rogers, Ray Dalio, and Jamie Dimon also appeared to wait for a deeper downturn that never came. Now, think about this. Why is this happening? Could it be that these influential individuals and institutions understand something the rest of us don't? Perhaps the issue isn't that crises have disappeared, but that powerful forces are now unwilling to let the game stop. They have found unprecedented ways to fast forward through any potential collapse. One could argue that we are all participants in a meticulously designed system, yet most of us have never been given the rulebook. Imagine we're playing a game of Monopoly. Now, imagine that I am the only player with the ability to print unlimited money. Every time I'm on the verge of bankruptcy, I can simply create more cash to keep buying property, building houses, and collecting rent from you. What are the chances I would ever lose? This is precisely the scenario that appears to be playing out in the real world. In recent years, an economic framework known as modern monetary theory (MMT) has challenged and seemingly overturned traditional economic principles. Proponents of this theory suggest that a way has been found to extinguish financial fires almost instantly by printing and deploying unlimited amounts of money. When the pandemic hit, the solution was to distribute money directly. When a bank was on the verge of collapse, the solution was to cover its losses. However, access to this solution is not equal. This new system seems designed to protect and perpetuate the wealth of the world's most affluent. The priority is not necessarily to help the wealthy make more money, but to ensure their assets are shielded from catastrophic loss. More importantly, from a cynical perspective, it could be seen as a way to ensure that the less affluent never get the chance to buy in at the bottom and climb the ladder. So, what does this mean for you? If you want to understand the forces shaping the next decade, and avoid being the last to know when opportunities arise, it's crucial to grasp how modern monetary theory may be influencing events from behind the scenes. First, you have to decide what you believe. Will money become less valuable in the future, or more valuable? Your answer to this question could literally shape the next 10 to 20 years of your life. So why have there been so few major crashes since 2008? The traditional cause of a depression, financial crisis, or stock market crash is simple: a lack of money in the system. Therefore, the solution is equally simple. If you can ensure there is always enough money, a crisis can be averted. Modern monetary theory provides the justification for printing money without the immediate, negative consequences that traditional economics would predict. The theory suggests it can be done indefinitely. If that's true, the supply of money will only increase, making its value decrease over time. In the past, during a depression or economic crisis, the government typically wouldn't intervene with massive bailouts. The prevailing wisdom, advised by economists of the era, was that the market had its own immune system. A collapse, though painful, was a natural and necessary process of self-correction. Government intervention was seen as protecting the weak and preventing stronger, more innovative companies from rising. It was like preventing the body's natural metabolic process, allowing zombie companies that should have failed to linger on, wasting resources because they knew they were too big to fail, and the government would eventually rescue them. The belief was that short-term pain was essential for long-term health. Think of it like a forest fire. While devastating in the short term, it clears out deadwood, viruses, and pests, allowing the entire forest to regenerate with healthier, more vibrant trees. For example, during the Great Depression of 1929, countless automobile companies failed. However, General Motors weathered the storm. It acquired its failed competitors, absorbing their technology, talent, and trade secrets. This consolidation allowed it to become the world's largest auto company, which in turn strengthened America's industrial power. From this perspective, a crash is a positive force. It overthrows the old guard, allows a new one to emerge, and ultimately leads to a stronger nation. This traditional theory is like a naturopathic doctor who believes even the most serious illness can be cured by the body's own immune system. But if you were part of that newly established elite, would you want to allow the same creative destruction to potentially overthrow you? Of course not. You would want to defend the empire you worked so hard to build. And so, after the Great Depression, a new class of capitalists supported a new government and championed a new set of economic theories. Their argument was compelling. If you're critically ill, do you simply wait for your body to heal itself? Why refuse medicine when it's available? A severely weakened immune system might not be able to recover on its own. It could fall into a vicious cycle from which it never escapes. While General Motors was a success story from the Great Depression, it was an outlier. The broader reality was that countless companies went bankrupt, leading to mass unemployment. When people don't have jobs, they don't have money to spend. When no one is spending, more companies fail. It creates a downward spiral, where no one is willing to do business or invest, even if they have capital. The economy grinds to a halt, and the nation risks losing its global standing. The new thinking positioned the government as a doctor. When the patient the economy is dying, shouldn't the doctor intervene? When private spending disappears, the government must step in to break the vicious cycle. This could mean spending directly on infrastructure like roads, bridges, airports, and railways. This creates jobs, gives people an income, and restarts the cycle of spending. It's equivalent to a direct injection of cash into the public's hands. At the same time, interest rates must be lowered to make borrowing cheaper, stimulating people to take out loans for cars and houses, and encouraging businesses to invest in new factories. From that point forward, the old self-repair therapy was abandoned. Whenever the economy faltered, the government would step in to save it, feeding medicine to the market. The power to manage this process by raising and lowering interest rates was given to the Federal Reserve. And believe it or not, this strategy of medicating the economy propelled the US far ahead of the rest of the world. Think of the economy as a car. If it's running too fast and risks crashing, the Federal Reserve raises interest rates, applying the brakes to prevent overheating and inflation. If the car is moving too slowly, the Fed cuts interest rates, stepping on the gas to stimulate growth. This approach worked effectively for decades, but in 2008, something changed. Even as the Fed slashed interest rates from 5% down to nearly zero, effectively flooring the accelerator, the economic car wrecked from the crash remained motionless. Why? The answer in part lies in technological advancement and productivity. Imagine the market has a total of $100 and produces 10 cars a year. The $100 is just enough to buy all 10 cars. Now, due to better technology, the same market can produce 20 cars a year. But there is still only $100 in circulation. Those 20 cars must now sell for a total of $100, meaning the price of each car has to fall. This is deflation. Even though productivity has increased, the static money supply drives prices down. As a business owner, producing more doesn't help if the price of your product keeps falling. Even with 0% interest rates, there's no incentive to borrow money to expand production because there's no profit to be made. Businesses fail, people lose their jobs, and the vicious cycle returns. So, what's the solution when the medicine of interest rate cuts no longer works? You move to direct injections. If there are too many products and not enough money, you simply create more money. After 2008, the Federal Reserve began its policy of quantitative easing, essentially printing money and lending it to the US government and banks at near zero interest rates. The banks in turn lent this money to large corporations and investors, who could then buy back their own stock or acquire other assets at depressed prices. The government used its share to absorb the toxic assets that no one else would touch. After 2008, the economic crisis didn't just disappear. In many ways, it deepened to a point where interest rate cuts were no longer sufficient. The Federal Reserve had to resort to direct injections of newly printed money. We saw the same playbook in 2020 during the pandemic. With the economy at a standstill, the Fed opened the floodgates, printing money on an unprecedented scale, and lending it to the government to distribute directly to the public. Even in 2023, when several banks failed amid rising interest rates, the Fed quietly used new tools to provide liquidity and prevent a wider collapse. The US economy, despite its underlying weaknesses, could be kept afloat by the power of the printing press. But is this endless money printing sustainable? Capitalists and the proponents of modern monetary theory (MMT) would tell you that it is, under one condition: the rest of the world has to help pay for it. MMT rests on two controversial ideas. First, government debt is not like household debt, because the government can always print more money to pay it back. In the past, the US dollar was pegged to gold. If the government printed $100, it had to have a corresponding amount of gold in reserve at the Federal Reserve. If you wanted to, you could exchange your dollars for physical gold. This gold standard placed a natural limit on money printing. To print an extra $100, the government needed more gold, but the supply of gold is finite. Often, the government would have to borrow from the market. If it couldn't raise enough through taxes to cover its spending, it would run a deficit and risk bankruptcy. That all changed in 1971, when the United States officially abandoned the gold standard. From that point on, the US could theoretically print as much money as it wanted. This is the foundation of MMT. Today, the US national debt is over $37 trillion, but there is nowhere near that amount of gold in its vaults. When it's time to repay that debt, the government doesn't pay with gold. It pays with dollars that the Federal Reserve can create at virtually no cost. The second key idea of MMT is that the more debt the government takes on, the better off the public becomes. The logic is that the government borrows, prints, and distributes money to the people, increasing their wealth. If you look at the economy as a balance sheet, government debt is a liability, but it appears as an asset on the public side of the ledger. However, you might notice that despite all this money printing, the average person's wealth doesn't seem to be increasing. Instead, we see inflation, which makes our money worth less. A $10,000 salary today might only have the purchasing power of $5,000 tomorrow. So, is MMT a failure? Not necessarily. The theory isn't wrong. It's just that the money isn't flowing to ordinary people. When the economy is in trouble, the Federal Reserve prints money and funnels it to the government and large banks. This capital is then lent at little to no cost to major corporations and investors, who use it to buy assets at bargain prices or repurchase their own stock. The money is created by the Fed, but it ultimately concentrates in the hands of the wealthy. The justification is that only by keeping these large companies afloat can jobs be preserved and the cycle of spending continue. So if all crises are fundamentally a crisis of insufficient money, and money can be printed infinitely, can a crisis truly exist anymore? When today's capitalists get into trouble, the system uses public mechanisms to bail them out. The rules of the game have been rewritten to ensure that the wealthy can not only outpace inflation, but also use it to their advantage, becoming even richer. As a result, they are not being overthrown and replaced. They are becoming more entrenched. This is reflected in the fact that the top 20 companies in the US stock market now account for nearly half of its total market capitalization. If you're still operating under the old rules, saving your cash and waiting for a massive crash to buy at the bottom, your savings are likely being eroded by inflation. As long as the global money supply continues to expand, the most important skill to learn is not just how to save, but how to invest and multiply your money through assets. Many people spend their time trying to time the market, predicting the top to sell and the bottom to buy. This is effectively gambling. For the rest of us, a more sustainable approach to investing involves developing a system with a high probability of success, and a risk management plan that ensures we can afford our losses. The goal is to lose less when we're wrong and win more when we're right. And if you haven't learned this system yet, I urge you to click the first link in the video description to join our stock investment class. For subscribers and fans, it's not $100. It's not even a penny, it's completely free. But I have to let you know, this free offer will be taken down soon. If you miss it, the content and all the benefits will be gone. But why can the United States engage in this level of money printing when other countries can't? The answer is simple. As long as the entire world needs US dollars, the inflationary consequences can be exported globally. Before the Industrial Revolution, humanity's biggest problem was insufficient supply. Not enough clothing. After the Industrial Revolution, the problem flipped. With machines, we could produce goods on a massive scale. The new problem became too many products and not enough money to buy them. America's domestic solution was to print more money. This problem of overproduction exists globally. Most countries are either manufacturing-based or resource-based economies, meaning they survive by selling things. If they can't sell their products, they face their own version of the Great Depression. When these countries can no longer sell their goods domestically, they must export them. When every country was trying to sell and no one was buying, the tensions led to 2 world wars. The United States largely stayed out of the direct conflict, preserving its national strength while profiting from selling arms. It emerged as the world's undisputed economic superpower. After the wars, the US stepped in and made a proposition to the world. You have products you can't sell. We are the richest country, so we will buy them. We'll be the market for your goods. You give us your resources and products. We will give you US dollars. You can then use those dollars to trade with other countries. As the world came to rely on the dollar for global trade, particularly for essential commodities like oil, every country began to hoard US dollars in their reserves. This need was brutally reinforced during the 1997 Asian financial crisis. The investor George Soros famously shorted the Thai baht, selling it off in massive quantities and buying US dollars. This caused the baht's value to plummet. Thailand didn't have enough dollar reserves to buy back its own currency and stabilize the exchange rate, and its economy was ravaged. That event taught the world a critical lesson. You must hold enough US dollars. If you run out, your currency and assets could collapse, leaving your country's core assets vulnerable to being bought up at bargain prices by foreign investors. To do business globally and protect your economy, you must hoard dollars. And the primary way to earn dollars is by selling your goods and resources to the United States. This creates a cycle where the Federal Reserve can print money, which flows to American capitalists, who then spend those dollars on cheaper goods from around the world, effectively exporting inflation and increasing their own purchasing power. This allows the US to focus on high-tech innovation, while the rest of the world supplies it with consumer goods. No other country can replicate this. When Argentina tried printing money during its economic crisis, it led to hyperinflation. Its citizens abandoned the local currency in favor of US dollars, and life savings were wiped out overnight. When Turkey cut interest rates and printed money, its currency lost 70% of its value in 2 years. For any country other than the US, newly printed money is often treated as little more than worthless paper. MMT in practice seems to be a superpower reserved for the issuer of the world's reserve currency. This brings us to the most important point. A true US financial crisis would likely only happen for one reason. If the Federal Reserve chose not to expand its balance sheet, that is, chose not to print money, and simply stood by and watched the system collapse. During the 2008 crisis, the 2020 pandemic, and the 2023 bank failures, the US averted a full-blown collapse by doing one thing: printing money. If they had done it sooner, the initial crashes might have been avoided entirely, as asset prices would have been propped up immediately. So why wait for a crash to start printing? A plausible explanation is that it allows those with capital to buy at the bottom. It can acquire assets at a discount, and then when the money printing begins, ride the wave as prices are pushed back up. It's a classic buy low, sell high strategy, enabled by the ability to control the money supply. The entire system of US money printing relies on the world's continued willingness to hoard dollars. To hoard dollars, countries need to earn them by selling goods to the US. But what happens when the US starts imposing tariffs and making it harder for the world to sell goods to America? It creates a contradiction. If the world can't earn dollars, the demand for them could fall. Last month, the US government borrowed another $1 trillion. Yet the Federal Reserve has not yet started a new round of quantitative easing to support this debt. Why not? Perhaps because it can't. While official inflation data shows a relatively low 2 to 3%, anyone living in the US can tell you that the cost of living feels much higher. The dollar's purchasing power is weakening. If the US continues to restrict global trade through tariffs, while the Federal Reserve begins printing money again, those newly created dollars could become trapped within the US economy, causing domestic inflation to spike. The magic trick of exporting inflation would fail. The dollar has already shown signs of weakness. If this scenario plays out, the dollar could be, as Warren Buffett once warned, doomed. This is the underlying risk that makes me cautious. While the US stock market may seem calm for now, storms often gather quietly. By investing in other markets like China and Europe, or in assets like gold, silver, and Bitcoin, I believe we can achieve growth without taking on the same level of currency risk associated with the US market. So if you want to understand the logic behind our investment and get our latest insights, I can only say this. If you haven't watched the stock investment class yet, go watch it now while it's still free and comes with all the benefits before it's taken off the shelves. Because if you miss this opportunity to enter the market, you don't know how many more years you might have to wait. The situation globally is only likely to become more turbulent, and it pays to be prepared. That is all for today. See you in the next video.